The biggest challenge in today's market for home buyers, I'd probably definitely say just there's a lot of noise out there in the market. Too many people that they're listening to, right, in their ear, mom, dad, telling them how difficult it is to buy a home, or what it's going to take to buy a home, and you know, you got to audit that. Not that it's bad to listen to mom and dad, but the reality is maybe mom and dad bought a house in 1990, or they bought a house coming right out of the housing crisis. Underwriting guidelines were different in 1990. They were different right after the housing crisis. So you got to take an audit of who you're listening to. They're listening to their coworker who bought a house, and the experience that they had wasn't exactly that awesome, and so they're getting that feedback from that individual, which, you know, at the end of the day isn't exactly what they need to be. Isn't it going to be their experience or going to be their type of loan that they're going to be getting? So I think it's noise. You know, I'll break it down into 4 really easy things that we deal with from an underwriting perspective, just so that it's clear. And, you know, I would advise them to talk to somebody that's doing this every single day, not their parents, not their co-worker. I mean, I've been doing this 22 years. I have a product specialist, I have an underwriter, I have a team of people that sit around me all day, because the guidelines change so much. There's so many little things that we look at to get the absolute perfect loan for every single buyer. And, you know, mom and dad, co-worker, just being honest with you, they're not the person you need to be listening to. You need to be talking to an expert. The 4 things that I focus on, and it's true in every mortgage, is there's 4 things that go into underwriting: capacity, credit, cash, and collateral. So collateral, guys, is just the property. That's just going to be the house, and we're going to do an appraisal on that property to make sure it's worth what you're buying it for. Okay, we're going to look at the foundation. The appraiser's going to look at the roof, you know, those types of things. But it's really going to be about value. If you're buying that house at $300,000 based on comparable sales, recent in the last 6 months, is it worth $300,000? Okay, then we're going to go to credit. Now, there's a lot of misunderstanding about credit. Do you take an average credit score? Well, no, you take the middle credit score. You throw out the high score, you throw out the low score, and you use the middle credit score for qualifying. And each loan program is going to have a different credit score requirement, and you don't need 700, 720 credit scores to qualify. You know, FHA will allow you to go down to a 580 credit score with just 3.5% down. We can go down to 530 on an FHA loan, but you got to put at least 10% down. Conventional goes down to a 620 credit score. Then you have VA at 600. VA is for your veterans, thanks to everybody that served in the military. And then you have USDA, and that has a 640 middle credit score. So they're not 720 credit scores. So we'll go through that, and the great thing about it is, guys, look, if you're not at the score you need to be at right now for the loan that you're looking to get into, we can help you get there. We do this every single day. There's what's called a what-if analysis. What do you need to do to make sure that your score gets to where you need it to be so that you qualify for the home loan? And this is something I'm very proud of. In the 22 years I've done this, not once have I ever told anybody, no, you can't buy a house. We're just telling them not now, but here are the steps that you need to take to get on the road to home ownership. It's simple. Cash. Okay, that's the third one. You know, do you have enough money to buy the house that you want to buy? Now, your cash can come from you as the borrower and your checking, savings, 401k. It can come as a gift from your family member. I mean, heck, we even have down payment assistance programs that will cover all of your down payment and your closing cost. We're getting people into homes right now with no money out of pocket. They're actually getting their earnest money back. VA and USDA have no money down. Okay, conventional, most people think goes to 5%. That's what, I mean, our parents may even be telling you, oh, you got to put 20% down to buy a house. I mean, conventional will allow you to buy a home with just 3% down. We can take that, add a grant to it, and literally you're walking in with no money down. FHA's 3.5% down. So don't listen to those that are telling you need to put 20% down. Some people will say you need to put 20% down to avoid paying mortgage insurance, and that's still not the case. There's several different ways of getting out of mortgage insurance. I'm even doing a 3% down loan, adding a grant to it, and then buying out the mortgage insurance for clients. And it's just that's why you need to work with an expert in the business, whoever it is, and not listen to others. Last thing is capacity. Now that you may understand that as debt to income ratio, which is just basically how we determine your ability to repay the loan, and we do that in form of what's called a debt to income ratio. And this ratio, how we get it is we take a proposed house payment plus the monthly debts that show up on the credit report, and we'll divide that by your gross monthly income. So simple math, you'd have a $2,000 mortgage payment, $1,000 in debt on your credit report, monthly debt, not your balances, but your actual monthly debt. And then we add those up, divided by your gross monthly income. So let's just say your debts, all that adds up to $3,000. Your income is $6,000. So that's going to be a 50% debt to income ratio. Well, how does that work? Can you qualify or not? Well, different programs again have different debt to income ratios. So if we're sitting on a conventional loan, the max that those ratios go up to is 50.00. So we typically see them at 49.99 get approved. Anything over 50.00 will not be approved through conventional Fannie Mae Freddie Mac guidelines as of this video. And then you have FHA. FHA actually allows you to go higher than 50. You can get up to 56.99 is where we typically see the absolute max. 57, they tend to get a decline on our approvals. VA has different calculations. They have ratios for the veterans. They also have what's called residual income, which allows you to exceed sometimes those ratios. But that's stuff that we go through at a conversational level with qualifying. So those breaking it down to those four simple C's to underwriting: collateral, credit, cash, and capacity, is really where you need to be focused, and why talking to a mom or dad, talking to a coworker isn't going to necessarily solve the challenge you have, or the concern or angst or understanding you have of whether you can buy or not buy. You need to talk to somebody that understands those four C's, that understands them, that works at them every single day, that has a team around them to help make sure they're digging into, okay, if the credit score is not there, how do we get the credit score up as quickly as possible? How do we navigate our ways through buying down mortgage insurance, buying it out because it's a monthly payment, and we can buy it out through a grant, reduce the payment by $150 and get the ratio from a 52 to a 47, and then get them to qualify. So there's a lot of strategy that goes into putting loans together. It's not just quoting a rate and taking the credit profile and putting a deal together for a client. There's a lot of strategy that goes into it. So I guess noise, would probably be the biggest challenge that's out there. You can get online and Google answers, and Google will give you 40 to 50% of the actual response. But I like it. I think it's great. I think my millennial clients that we're doing business with, that are coming to me, they're so much more knowledgeable than ever before, because they are actually using the resources that are available to them, but then they don't know 100% of it. They feel like they maybe know 100% from that and talking to people, but they don't really know the true loan products and maybe how to navigate your way through that loan. So that's probably what I'd go with, is just noise.